Okay, Salesforce stock cut in half. Adobe down 40% from its high workday. Snowflake, MongoDB, OTA, all bleeding. The entire software SaaS sector, software as a service, has just been taken out behind the woodshed 5 years ago. These were the untouchable market darlings. You could not buy them because they were just too expensive. And today, they are being tossed to the side of the road. And Wall Street is convinced AI is about to finish them off. So here's what I want you to consider right now. When Mr. Market panics this loudly about this many companies at once, he is almost always doing one of two things. He is either correctly pricing in a death sentence, or he is handing long-term investors the opportunity of a decade. In this video, I'm going to show you the one question that separates these two scenarios, and I am going to walk you through a real example that is trading today where the numbers are frankly hard to believe. So let us talk about it. Now, before we touch a single stock, you need to understand something most retail investors get wrong. Not all sell-offs are created equal. You guys, there are three completely different kinds of sell-offs, and they each demand a completely different response from you. The first one is a company-specific sell-off. Management blows a big decision, growth stalls, or fraud surfaces. What happens is the stock drops, and the drop is usually deserved because the underlying business is actually worse than it was yesterday for the long term. The second one is a market-wide sell-off. Interest rates spike, a bank fails, liquidity evaporates, and everything gets repriced at once. So, the good, the bad, the ugly, it all goes down together. And these are the exact moments Warren Buffett lives for because great companies go on sale right alongside the junk. The third one, which is the one we are in right now, is an industry sell-off. Not one company, not the whole market, but one entire industry is repriced simultaneously because of a major shift in the narrative of that industry. Industry sell-offs, in my opinion, are the most misunderstood events in investing. Why? Because in the middle of them, the market stops being precise about the value of these businesses. Uncertainty is running rampant, and investors on Wall Street cannot yet tell who the winners and losers will be. So they just dump everything in the sector. They dump the best companies. They dump the worst companies. They're all treated exactly the same. And that lack of precision, that is where the opportunity lives right there. That is where the gap between price and value can blow wide open in the best businesses in the industry. But you have got to know what to look for. So right now, software is ground zero. AI has created a wave of existential uncertainty across every SaaS business on the market. Investors are asking if AI will replace this product, if the pricing will collapse, or if growth will flatline. And rather than answer those questions carefully, one company at a time, the market is just selling. So here's the one question, the one I promised you up top, that will tell you whether each of these fallen software stocks is a trap or a treasure. Is this disruption structural, temporary, or irrational? Now, that distinction is absolutely everything. Structural means that the long-term earning power of this business is permanently lower. The moat is broken and the product is going to be replaced. Think Kodak when digital cameras arrived. That was not a dip in Kodak fortunes. That was a funeral because it was a structural change. And when that happens, Mr. Market is right to punish the stock. And a lower price today will look expensive a year from now as that company continues to decline. Temporary means the fear is real, but the moat is actually intact. In other words, revenue and earnings will take a bruise, but then they are going to recover. The company will come out the other side stronger with weaker competitors gone. Think, for example, Texas Roadhouse during lockdowns. When these restaurants closed, the revenue disappeared and the stock cratered. Anyone who understood their moat made a fortune as the stock rocketed from 35 to 200. Now, the third one, irrational, means Mr. Market fear is based on an emotional reaction to something new in the industry. Netflix stock tanked from 66 to 19 when big tech and Disney decided to become streamers, and then we got into a cyclical meltdown. Then it just turned out the new streamers did not matter as much, and the stock shot back up to 120. And that is exactly where I think we are with Salesforce. Your entire job as a disciplined investor in this moment of AI entrance into the SaaS industry is to sort each software company into one of those three buckets. Did AI cause a structural, temporary, or irrational repricing? You get that right, and you do not need to predict the exact future of AI. You just need to recognize a durable moat when you see one. So let me make this concrete. I want to walk you through one company in this wreckage, not as a recommendation, you guys, just as an example of how to think. So here is the setup for Salesforce. Salesforce is the system of record for how most of the developed world manages its customers. Sales teams are tracking deals in it, marketing teams are running campaigns out of it, and support teams live in it. If you are in a mid-size or large business, your company revenue engine probably runs one way or another through Salesforce. Now, here is the big fear. Wall Street thinks AI agents will eventually match what Salesforce does faster, better, and cheaper, or at a minimum. AI will collapse the number of seat licenses that companies need. Fewer licenses, lower revenue, crushed earnings. Now, that is the bear case, and it is not completely crazy, but here is what Charlie Munger would tell you to do. Invert, always invert. Instead of asking how could Salesforce win, ask what would it actually take for a competitor to kill Salesforce. Well, to kill it, a customer would have to rip out the central nervous system of their business. They would have to migrate years, sometimes 2 decades, of proprietary customer data. They would have to retrain all their employees, rebuild every single integration. And they would have to trust that a brand new AI agent, one that might hallucinate or drop a record here and there, is going to replace the information that their entire revenue depends on. Picture yourself as a vice president of sales who champion that switch. What is your upside if it works? You have modestly lower CRM costs. What is the downside if it fails? You blow your quarter, you blow your year, maybe you blow your whole business, and for sure you get fired. Now, that is a massive switching cost, and that is an incredible economic moat. Moats built on deeply embedded workflows do not crumble in 12 months. Just because a new technology arrives at worst case, they tend to erode over a decade, if at all. So here is the disconnect, the part I said that was really hard to believe. Since its highs, the Salesforce stock price has been cut significantly. The price-to-earnings ratio has dropped from near triple digits down to around 22, a 22 price-to-earnings ratio. What that implies is that Mr. Market is expecting this business to grow at maybe 10 or 11% a year going forward. But if you look at the fundamental tracking, enterprise earnings grew 20%, operating cash grew 16%, free cash grew 15%, and equity value grew consistently. So it is priced for 11% or worse on a business with a really deep, expensive two-switch moat growing at 15 to 20%. Now, that is exactly what a gap looks like between price and value in an industry sell-off. And that is Mr. Market smelling smoke in a theater that is not actually on fire, and all the Wall Street lemmings are running for the exit. Now, very important, I am not telling you to buy Salesforce stock. That is not what this video is, and that is not what we do here. There are still legitimate questions about how AI reshapes the CRM industry in the next 10 years. And you should always take the bear case seriously. Munger said it so well. You must know the opposing argument better than the people who are making it. And that is how you avoid losing money. What I am telling you is this. When an entire industry gets repriced because of fear, your job is not to run with the herd. Your job is to look at each company inside the wreckage and ask 3 core questions. Is the moat intact or is it breaking? Are the financials still strong or are they deteriorating? And is the price now sitting well below what the business is actually worth? And when all 3 of those things line up, meaning you get a real moat, really good financials, and real fear dragging the price down, you lean in, you do the work, and you make up your own mind. That is so key to this whole game because, as Buffett and Munger have said many times, Wall Street can make witch doctors look competent. Their opinion is not automatically better than yours. In fact, since you can think in 5 to 10 year periods, even decades, and they can think only in quarters, you have a real edge in moments, exactly like this one. Look, you guys, in moments like this, an entire industry is on sale, and nobody can tell the winners from the losers on Wall Street. And that is exactly why a structured value framework exists in the first place. This is when your discipline earns its keep. If you want to learn how to read a moat, how to pressure test a balance sheet, how to calculate what a business is actually worth, and how to set your buy price with absolute confidence, you need to treat this as a skill set. Investing is a craft that pays off when fear is running high. If you want to master that skill set before the next industry sell off shows up, because there is always a next one. Check out the resources below. Thank you for watching, you guys. Now, go do the research, stay disciplined, and I will see you in the next video.